Welcome to the Mortgage Brothers Show. I'm Eddie Knoell.
And I'm Tom Knoell.
Welcome, everyone. This is our third podcast, and today we want to talk about an actual loan program that we think is important to bring up and discuss. Right, Tom?
Yeah. Before we talk about loan program, can we talk about a SOC program real quick?
A SOC program?
Yeah, what are we talking about? So I'm getting ready for work today, and I'm thinking, what kind of shirt am I going to wear for the podcast? And I need to get dressed, so I got out my socks, and I laid out, and I think we'll probably maybe post a picture, but I laid out like a dozen socks, and they're all black. But every single one of my socks were all different. And I was thinking, how does this happen? So anyway, I just thought I had to share that story. I know
people have had this sock problem. I think it's like from eternity. The people have had this problem. Now, that's why I went to all the same style about 10 years ago.
Well, you're smarter than I am because I should have done that. Anyway, that's how I started my day off. But I was thinking about the podcast as I was getting dressed, and I'm thinking, this is unbelievable.
That's funny.
Unbelievable. So, okay. All right. So you want to talk about loan program.
Yeah, that's right.
And what is this program for?
Well, people call or email us about first-time homebuyer programs, which we have. And we want to talk about one of the best – we were going to talk about the best first-time homebuyer program that we have and what we believe is the best first-time homebuyer program in the country. But people call about down payment assistance programs.
Also known as DPA.
That's right. Say, hey, I'm a first-time homebuyer and I want to put zero down. What kind of programs do you have? I mean, that's the question, right, we get.
Mm-hmm.
So the answer is we don't have down payment assistance programs. And there's a reason. I'll tell you about this. The down payment assistance programs, I want everybody who's listening just to be really careful when they do down payment assistance programs. Because there's all sorts of marketing, and I would say scheming that goes on with the banks. They want you to sell mortgages. They want buyers to get out, or they want agents to sell homes. They want buyers to go out there and buy houses with, to generate mortgage deals and actually make money. And the problem is if volume's down, these banks will promote these programs with zero down.
Mm-hmm.
And anyway, they call them down payment assistance programs, and they have high interest rates. A lot of them have high interest rates, and a lot of them have high costs.
So can I just tell the audience why they have a high interest rate? Because sure. when I get calls and people ask me, what are we considering in terms of the first time home buyer programs, I say there's really going to be two options for you. We can do one of them, which is the best in class alternative, which give you the lowest interest rate. The other alternative is DPA. And you have to look at it from this way. Look at it from the standpoint of after your loan gets done, who's purchasing these loans? The investors are purchasing them. I say, okay, now put yourself in the seat of the investor. If you yourself were the investor and you had two loans to purchase, you had one loan that was a conventional Mortgage Brothers team type, best in class, first-time homebuyer loan, or if you had a down payment assistance loan, which one would you pay more for? Or what would you pay for them? Well, they say, well, we'd probably pay less for the down payment assistance program because we know the borrower didn't have as much money in there. The risk was higher. I said, exactly. So in order for those investors to get the same type of yield on those two different loans, they have to charge more money. So hopefully that kind of makes sense. But these literally, put yourself in the shoes of the investor. When you go to buy these loans, of course, the one with assistance will not be worth as much. Therefore, in order to make it up to the investor would have to pay less or charge you more interest so that they pay the exact same amount as for the other one.
Yeah.
So hopefully that kind of makes sense.
That's right. I think so. I mean, I think that I think it is hard to articulate to the audience, but that, you get what you pay for. And especially with these programs, if you're getting a zero down payment assistance program, 90% chance that you are overpaying on your interest rate, maybe 1 to 1.5% higher interest rates, and the closing costs are higher. They might have to have the seller kick in a contribution. Now, I want to basically just put it out there that there are grant programs that are available. Now, you and I don't deal with grant programs that the city or counties offering. You have to qualify within a certain, you have to have a certain income. You have to buy in certain neighborhoods. In some cases, there's certain things you have to qualify for. So we're not experts in all programs, but the programs that we see come across our table that our customers are saying, hey, this is a program that was being offered to us. What do you think of it? It's zero down. It's usually crap.
Mm-hmm. And we did work on a grant program about 2 months ago. I don't know if you recall, but it was in the city of Phoenix. And after working about 3 weeks on it, the city of Phoenix ended up contacting the borrower/buyer and saying, sorry, we decided to take another application. So the borrower was very, very frustrated. Ended up finding another home a week later, and they came up with their 3% down. Actually, they bought a manufactured home. So we are able to do those grant programs, but they're very few and far between, and there's usually catches on them. There's limitations.
Yes, that's right. And I'm gonna do a small demonstration, or just to show how expensive this can be. If someone wants to do a down payment assistance program, and they want to, compare it to the program that we're gonna recommend. Okay, actually, we have to talk about that. What program are we offering our borrowers in lieu of like these down payment assistance? We're offering them a 3% down conventional loan with great rates. Okay. So now, as of this recording, it's March 13th. You can get this a 3% down conventional loan for a first-time home buyer with about 4.25% on the interest rate. And that's with the credit score of like a 680. Now, I'm going to also say that that's an APR of about 4.6%. And that's because of there is mortgage insurance in the program. That's better. That actual rate itself is better than a conventional loan with 20% down with an 800 credit score. So this program is a really good program. Again, it's a conventional program. It is 3% down. Now, if someone's still wondering, well, I don't know if I have 3%, right? Maybe I still should go for a down payment assistance program, those DPAs. I'll explain it to them like this. If my interest rate's 4.25% today, those down payment assistance programs are probably 5.25% to 5.5%. What's going to happen, and that's on the whole loan. So let's just take a sales price of $200,000. If they don't have 3% down, that's $6,000, right, for the down payment that they have to come up with or save or receive as a gift, right? If they don't have the ability to do that, if they go the down payment assistance route, they're going to be paying approximately about $2,500 more in interest on their payments per year. Their payments are going to be $2,500 more a year.
They're going to have, so someone that's coming to us looking for help is actually going to be having to pay more per year. So how does that work, right? On the down payment assistance programs. So someone coming to you looking for assistance, they're actually having to pay an additional, what did you say, $2,500 a year?
So if someone's looking for a down payment assistance program, what I'll explain to them is that their payments are probably going to be about $2,500 more a year. That's like $213 a month more, just because of the higher interest rate they're going to be paying on a down payment assistance program.
Which doesn't sound very sustainable to me. Why would someone do that?
Well, because they need to get in the house. They believe that they have to get in that house right now.
Right. But I guess the whole point is that they shouldn't. They come to you needing money because they don't have it. And instead of going with, the best in class loan that we could provide, they go for a down payment assistance program, which allows them to potentially have no money down, but they're paying an extra $2,500 a year.
Yes, $2,500 more a year because they did not have $6,000 for a down payment. Now, if you do the math, it's about 42%. It's like paying 42% interest on the money for the down payment that you didn't have. That's why it's so important to look at your resources as a borrower and think, okay, can I get a gift? Can I save the money, at least part of the money? Is there anybody in the family I can go to?
So just a couple of things. Yeah. And before I jump into how we get to the 3%, so I just multiplied $2,500 per year by 7 years, because that seems to be the average time a person stays in a home. That's over $17,000. $17,000 for a person coming to us for a first-time homebuyer program. We would never offer that. So real money. And then in terms of the 3% down, when I get calls, I tell people I break the 3% up into 3 different components. 1% from you, 1% from maybe a 401k that you forgot about. There's lots of employers and these employees, especially the first time home buyers that have been working for a couple of years, I didn't even know that they had a 401k. And then 1% from a relative. So 1% from yourself, 1% from a 401k you forgot about, and 1% from a relative. You're in a best-in-class loan, no extra, premium associated to it.
That's right. And, a lot of us have employers that are flexible with us, as employees. Gifts from employers are also eligible.
Oh, that's right. Good point.
Go to your boss, ask for a bonus. If you've been doing a great job, this is a perfect time. You're buying a house, ask him for a bonus, something like that. And now it can be a gift or bonus, but anything like that. This is a.
Now, are there income limits to this program?
Yes. And so that's right. So let's just talk about what the requirements are. In Maricopa County, there's a whole website that breaks down areas that have income limits. Some areas don't have income limits. So the income limit is the Maricopa County median income, which is $69,100. So if you make more than $69,100, you won't be eligible, and that's per year. You won't, if you make more than that, you won't be eligible for the program unless you buy in these certain areas in the city,
which are usually on the perimeters, right?
Yeah. Well, that's right. They're going to be in areas. They're scattered throughout the whole city. Everywhere from Mesa, Gilbert, Chandler, Phoenix. Up North Phoenix. So they're all throughout, and they're even in Central Phoenix. So it's.
I did not realize that. I thought they were all peripheral.
No, they're based on the census tracts done in 2010. So the census that was done, they calculate these areas, and it's not even per zip code. And so, the way that you would actually, and we can help, them find the map, that will help them guide them through the map. There's an online link that we'll give them. But in any way, if your income's over $69,100, you wouldn't be eligible for the program unless you buy in these certain designated areas. But there is also an online course that needs to be taken. And it really teaches homeownership responsibility, or responsible homeownership. What is it? What does it mean?
I think it costs about $75 and is about a 2 to 3 hour course.
Yeah, they just,
if I'm not mistaken.
Yeah, they just self-pace online and to do it.
Yeah.
Anyway, it's a great program. And interest rates, like I would say, are better than someone with a 680 credit score with 3% down on this program is going to have a better interest rate than someone with an 800 credit score with 20% down. So it's pretty amazing.
That is, and you're actually right. You're right about that.
Yeah, just priced it out today. Well, right now we have very good pricing on this program. So again, this is a conventional loan program, and we get automated approvals on it. So
we don't want to be making our 800 credit score borrowers angry right now.
No. Again, these are for borrowers with little down. Now, if this program is to help borrowers with little down, okay. Really, if you have an 800 credit score, 20% down, even though your interest rate might be a little higher, you're not going to have mortgage insurance. So it is still better to go with 20% down if you have it, right? Mm-hmm. And so this program is not just to do because it has a lower rate. It does have mortgage insurance, but mortgage insurance is very competitive and very good, if you have to have it.
Okay. So should we just summarize here real quick?
Sure.
Okay. So when you get a call or you yourself are looking for a first-time homebuyer program, you need to be thinking of two different programs if you come to work with the Mortgage Brothers team. One is the Home Ready product, which is 3% down. It'll give you a discounted interest rate, and it'll get you a discounted mortgage insurance payment. If you don't have as good a credit, then you would go towards the FHA program, which is 3.5% down, which is a phenomenal program. There is an upfront mortgage insurance premium associated to it, which helps keep that monthly mortgage insurance payment low per month. But those are phenomenal first-time homebuyer programs, the Home Ready Conventional and the FHA.
Yes, and I think we should do an episode, a whole episode on the FHA loan. But again, like you said, the big thing about the FHA is really caters to the lower credit score borrowers, and it is a great program.
Perfect.
Yeah. Well, thank you everyone for listening to this podcast, and I hope you've enjoyed it. I hope you have a great week. Thanks, Tom.
Hopefully we haven't put anyone to sleep. Thanks, guys.
See ya. Hey guys, thanks for listening to the Mortgage Brothers Show. Please let us know if you have any questions you'd like us to answer on this podcast. You can email your questions to Tom at azmortgagebrothers.com or yours truly at eddie@azmortgagebrothers.com. And be sure to ask us for a free quote on your next mortgage. Tom and I will personally work with you and help you through the whole process. Signature Home Loans, LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917 and 1618695, Equal Housing Lender.